Thank you all for coming today. Kind of same format that we've been doing. I'll hit the market real quick and talk about what I'm seeing there, and then we can dive into the topic today. Right now, let me silence this favorite camera. So, obligatory staff page, and then kind of what we're seeing. So, markets have been moving stronger here lately. Since we bottomed out there in April, we've been moving higher. We got back to all-time highs for a little bit there, and then we've kind of leveled off, and then kind of the same playbook that's been happening of anytime tariffs are in the news and Washington getting involved in what's going on with trade. Market cools off a little bit. We did see the passage of the tax bill, which we're still in the process of diving through all the finer details of that. But we're for the most part, through that process, and we're going to be able to talk more about that at the Lunch and Learn next month when we get that all set. So if you don't have that in the schedule, maybe you want to take a look at that one. We're going to try to really dive into what that one means for you guys. We've had strong earnings out of banks, airlines, consumer sectors have had some good earnings, but we also have seen inflation tick up here recently. Seen bond yields kind of shoot up a little bit now that we settle back down. So lots of noise, a lot of kind of similar things that we've been dealing with, but for the most part, the thesis of the AI revolution and the strong market and the economy continuing kind of in the same boat. So I'm comfortable with allocations. I don't think we've got a need of making any changes there. So kind of, moving on to what today's topic is, and feel free to jump in wherever if you have questions. Tax loss harvesting. So that concept of not every loss is a loser. It's when we sell an investment that has dropped in value kind of to lock in that loss for tax purposes. And that loss can be used to offset other capital gains. And almost, every year we're going through people's portfolios and saying, kind of near the end of the year, are there any places that we can harvest losses to make our tax situation better? So we're combining a gain with a loss to reduce the bill. And it's one way that you can kind of make volatility work for you. And the biggest thing that we have to be aware of is the idea that if we lock in a loss, there's a rule called wash sales that we're not allowed to rebuy that same position within 30 days. So if I had a gain in Apple and a loss in IBM, and I sell IBM so that my gain in Apple doesn't affect it that much, I can't then go back and rebuy it right away. But I can buy something that is similar. So what we've done a lot of times in the past would be, we could buy the S&P 500 and have that be a holding place for 30 days. And it's a really important way of working our way out of some of our positions without, paying taxes on it. And kind of to give you an example of what we would be looking at. So this is kind of the idea. So investment A, you've got $20,000 in cap gain. So in this example, let's say you were in, had a 35% tax bracket. Now, recognizing, right now our cap gains rates are different. I pulled this illustration off the web, but it kind of illustrates the point. That'd be $7,000 in tax gains. If we were in the 10% bracket, $20,000 gain, $2,000. If we were 20% bracket, you get the idea. And so if at the same time that we had these gains, we sold this investment B over here, that had a $25,000 loss, now we have offset that completely. So the $20,000 gain over here and the $25,000 loss would offset, but we also have an additional $5,000 worth of loss. And so that's where we can take an additional $3,000 off of our ordinary income. And whatever that tax rate is on your ordinary income, that's potential savings. Now, if we had $20,000 of gain and $20,000 of loss in a calendar year, they just offset each other. There's no taxes. But in this scenario with $5,000 worth of loss, let's say we wiped out all of our losses, we can actually take that $2,000 that was left over and apply it to next year, and then the next year and the next year, depending upon how long it would take us to work our way through that. And it matters significantly, especially in these times where we've seen kind of parabolic market moves in certain stocks. So thinking about like NVIDIA and Apple and Google and Microsoft and all these that have run up, or long-term hold positions, So a lot of you might remember kind of the first Horizon days where we ended up having cost bases of like $2 a share, and then it got up to 40. And so how do you unlock that without paying taxes? And tax loss harvesting is a big part of that. And one of the things that I think is really important in looking at it is, and this is kind of the way I approach it when I'm looking at someone's investment portfolio at the end of the year, is to say, well, do we have losses that we want to take just to have losses and to carry them forward? Can they carry forward on your scheduled date? That's one way of looking at it. Or do we have gains that I'm now uncomfortable with the size that a position has become in the portfolio? So it's not uncommon when you get a winner. We've seen this like with Fortinet, over the last couple of years, and some of the tech positions that I mentioned, that it was a 1 or 2% portion of the portfolio, but now it's 6-7%. And so not only do we have the gains that we have to pay taxes on, but now we have the additional risk of it's an oversized position. We have less diversification. We have more individual company risk. And that ability to right-size positions is extremely important. And it's something that we're always trying to balance off. Now, one of the things that we've run into, if you go back to 2009, the market has been pretty straight up. We've had some dips. We had COVID. We had, a few places where we had significant sell-offs. We had the sell-off earlier this year, but, the immediate rally back. We do have some of these long-term positions that have generated long-term capital gains. And really the only other way around capital gains is either finding other losses within the tax system, so business losses outside of it, or tax credits, or whatever that would happen to be, or the alternative that nobody wants, which is if you pass away and it steps up in basis, and then your heirs can sell it without paying taxes. So tax loss harvesting, really important. It's just one of those things that even if you don't change the overall structure of an account, it can be a way to improve overall returns. And one thing that I think is relevant to this whole thing is kind of looking out and deciding whether or not it matters. Now, there's obviously 0% tax on capital gains for lower income levels, and you've got other places where you can wipe out, overall, or your just overall income, even with capital gains, it's not that much. So your taxes aren't that great. Your standard deduction wipes out whatever it happens to be. But it is a place that, if we have 100,000, let's look at it this way, I guess. Let's say we had $100,000 portfolio, 50,000 of it was in a stock that had this 20,000 in gains, and 50,000 of it was in a stock that had $25,000 in losses. So we've got $100,000 in the account. Let's say we didn't want to sell investment A. We could sell $3,000 worth of investment B, and for $3,000 of the loss, so whatever dollar amount that made up, have that $3,000 to apply to our taxes, and then either in 30 days rebuy that exact same position back, or find an alternative. So it wouldn't be uncommon to say, okay, well, let's shift out Chevron for Exxon, or Johnson & Johnson for Eli Lilly, or JP Morgan for Bank of America. Those type shifts are fine. Or let's put it in money market for 30 days and then rebuy. And so those are different ways that we can add little bits of return and goosing it without even changing the structure of the portfolio. So you might still be a 50-50 portfolio, 60-40, whatever it happens to be. That's, a big part of it. We'll also occasionally do this with bonds that have dropped in value because of the way the interest rates have moved. And so we are, so let's say interest rates increase, so your existing bonds are worth less. And so we could sell that exact same bond, take that money, buy a different bond that's going to have the same yield to maturity that one did, but we now have the tax loss harvest. So that it can apply in all those situations. And I will say it doesn't apply to IRAs, because this has to be in something that we're going to get 1099 consolidated at the end of the year. So on Schwab, it lists the gains and losses based upon position. It will recognize whether or not something, was a wash sale or not. So occasionally you'll get those adjustments. But that's the concept. It is a way of taking things that were, not ideal. Nobody wants to lose money. But maybe it's something that's lost money temporarily and we expect it to come back. So we're still okay with that position. But do we have the ability to make it work out for us tax-wise? That's the concept. I'm happy to dive in further on that. I'll open it up for questions. I do have a few that were sent in that I've got on my screen that I can hit. All right, let me pull up one of the questions that got emailed in. So, is there a downside to tax loss harvesting? Mainly the downside of tax loss harvesting would be is if we replaced it with a weaker investment, or we missed out. Like, let's say we set it in cash for 30 days and the market rallied, or we sold Exxon to buy Chevron, and then over the next 30 days, Exxon returned to value and Chevron didn't. Those are kind of the downside risk. It's not really a deal breaker, but it's something that we have to factor in. How long can we carry forward losses till they're gone, or until you pass away? Once you pass away, those losses go away. They fall off your tax return, and they're just unused. But let's say we took $25,000 worth of losses, and then no gains. So we take 3,000, or let's make it 24 so that it lines up easier. For the next 8 years, if we never took any gains, we could chop $3,000 off of our income for that time period. We're doing nothing. And so if we're saving 35% or 20% or whatever it is, it's a savings that doesn't occur. So if I run a portfolio report and look at performance, it doesn't reflect there, but it definitely shows up in your overall taxes.
I'm just curious, your examples have all been equity and have been stocks. Is there any type of harvesting losses for bonds and fixed income?
Yes. Yeah. So it's any position can be harvested. So whether it's a bond, whether it's a mutual fund, whether it's an ETF, anything that we have started out at a position and then drop, that would be eligible for tax loss harvesting. And so
30-day, from where does a 30-day rule come that you have to, you can't reposition in the same entity within 30 days?
it's just within the same entity. Yeah. So, and it can be, it's the same security. So it would be the type of thing that, I can't buy Apple back if I sold Apple, and that's what the loss happened. If I sold a Ford bond and then replaced it with a different Ford bond, that's kind of a different scenario in that it's a different QSIP, so the bond identifier, but it is still technically a wash sale. So I would then need to buy like a General Motors bond. So if it's within the same issuer.
So it's the same family. Ford's within the same family. You can't really replace a Ford with a Ford. You have to cross over to General Motors or whatever.
Right. To be safe. Now, technically, you could probably get away with it because some of these companies will issue out tranches of bonds that all have like the same maturity, same coupon, but they've got some other covenant that makes them different. Those you definitely trigger the wash sale. So let's say you had a Ford that matured in 2030, they have 5% coupon, and then you sell that and you buy a Ford that matures in 2030 with 5% coupon, but it's got this weird covenant over here that if GM sales or something or other, they can call it back. They're going to look at those as substantially the same. If you have a Ford 2035 bond at a 4% coupon, you could make the argument that it is not a wash sale, but that's not one that I would want to fight the IRS on.
Right.
And there's not normally a need.
And none of this actually applies to IRAs.
Correct.
And 401ks, right?
Correct. It's only taxable accounts. It's one.
Right. That makes perfect sense.
We're dealing with the tax ramifications of having like the dividends and interest. And that's kind of an interesting thing too, is we talk about it offsetting the other capital gain, but if you wanted to look at it this way, it's not a direct offset in that it doesn't flow through the Schedule D this way. But if you had $3,000 worth of dividends earned on one stock, and we take a $3,000 loss, our capital loss on a different stock, that could zero each other out on the tax form. It's just one's higher up and one's lower up.
Yeah.
So that extra $3,000 off is a valuable tool. Like I said, it depends on where your tax rate is on how valuable it is. But in the 10% bracket, it's 300, and 30% bracket, it's 900. So it can potentially be very large. And what we've seen too is these capital losses can sometimes also happen within a private business. So if we had a share in a local, I don't know, it's not the exact same way because you get net operating losses. But if we sold the business, so like let's say it's shut down, like we just went bankrupt and we shut it down, that would be a net operating loss. It would flow through the tax form in a different place. But let's say I had a basis in Aldebaran, and then I go and I sell it for less than what my basis is. It's still it's still a stock loss. And then that capital loss offsets just like a stock. So, and that's how sometimes we see that in family businesses because, they assess a value, like Aldebaran was assessed a value for dad's estate. And that's the cost basis that goes along with those shares. If for whatever reason, I sell those shares down the road, then that could potentially create a gain or a loss. And so that was one of those things that I worked with on the account. You want your A small family business, a farm, any of those type of things, a business like this one, you want your basis high enough that if you did want to sell it down the road, you're not going to get crushed on taxes. But you want it low enough that you don't trigger estate tax.
Right, exactly.
So you're always kind of playing that game. And family farms is actually a big issue. And that's one of the reasons why you see the estate tax when they're always talking about trying to bring it back down, who needs to pass on $10 million, those type arguments. Well, when you put the value of farmland into some of these equations, you might have a farm that is, you're barely scraping by, income wise, but the value of the farm with the land is massive. And so sometimes that's where those issues can crop up. And you could have a $20 million valued farm that's not really making you any money and you don't want to sell it. And if you did actually have to go out and sell it, is that the price that you get? But if you had to value for estate tax purposes what it's worth, you kind of get crushed. So those are different issues, but they are, private stuff works just the same way. Technically, and let me look up the rules here, because there's another kind of issue in that, especially in today's day and age, Bitcoin would be one of those things too. Like if you owned a physical Bitcoin and it dropped and went up, that applies in the capital gains world. I'm going to look up real quick the collectibles because those are not treated the same way. Because so if we were to look at like if we sold a baseball card that we bought for $10,000 and then sold it for $7,000, that's a loss. And so if you sell a collectible at a loss, it is a capital loss and can be used to offset. But and there's no wash sale that can really apply there for you're not going to buy back the exact same baseball card, and because for each one of them there's only so many. But the weird thing with collectibles was it a personal use item? And that it has to be a true collectible. So, the thought process might be, well, let's say I bought a antique bed as a collectible and I spent $3,000 for it or $6,000 for it. And then I sold it. So if I bought it for $6,000 and then I sold it for $3,000 and wanted to take it as a collectible loss, unless it was truly held as a collectible,
right,
it doesn't count. Now, a lot of people would say, well, it had that, but it was personal use in there. Now, the IRS would have to identify the fact that you had done that, and that would be hard for them to do. But it is illegal. That personal use comes in,
like for a collectible car as well. I mean, if you're
right.
using a antique car as your personal location, it's no longer a collectible car.
To show it off. But if you were using it to commute and calling it a collectible and then you sell it at a loss, they're not going to say it.
Yeah, they're not going to buy that.
Yeah.
Well, thank you so much, Peter. I really appreciate it.
Absolutely. I appreciate you hopping on. And I think those were all the questions that I had that had been sent in. So we're good to go. And I'll do what we normally do. I'll clip this and record it, and we'll put it out with Josh and all of his stuff.